Good morning, Karen, and thank you for having me on your show. Well, we're positive on the outlook for equities at a global level, and within Europe and the UK, we're thinking that it's a great way to get global exposure because the markets are dominated by cyclicals and value. You mentioned the bank sector, and that's a sector that we've been overweight. It's had a strong rally. We think it's got a lot further to go, not only with the catalyst of a steepening yield curve, but also the catalyst of the central banks in Europe and the UK now allowing dividend payments. That's going to, we think, encourage investors at a time when returns on equity are rising and price to book values are under 0.5. So value and cyclicals we favor at the moment, and we think that it's a good opportunity to buy them both into weakness in Europe and the UK.
The call should be a positive one for UK stocks, but I just want to weave in a couple other factors here. An interesting report that Japanese investors have been buying UK government bonds at a record rate in early 2021, according to the FT today. And that's a bet on the pound. You're also positive on pound, but at what point does that stall the rally that we've witnessed in the FTSE 100?
Well, we've been positive on sterling for 6 months, and we now think it's going to consolidate at these levels, partly because we're seeing a stronger story for the dollar. The relative growth momentum and relative yield argument is moving in favor of the dollar. So stability for a period at 140 to the dollar. We think in terms of the impact on the market, the inverse correlation that sterling has previously had is less important now, because most investors are underweight both the currency and equities. There's pent-up demand, and what we've seen in the last few weeks is what we're likely to see moving forward over the next few months, and that is both sterling edging higher and also equities edging higher at the same time.
Jeffrey, my question is, what's your time frame on this opportunity? We had one guest earlier in the programme, Dan Lacaille, who thinks that the juice runs out once we get to the thick end of the reflation, and that ultimately we will then start reverting to the kind of deflationary backdrop that was beginning to emerge at the tail end of 2019, early 2020. Is there a tactical opportunity to make money here by going along these risk assets, and do you have to stay close to the exits, or do you think we're at the beginning of a new cycle?
This is the start of a new cycle, Jeff, that's about 8 months old only, and we think there's a lot further to go. Our horizon for the tactical trade is 12 to 18 months. What we've seen so far in the economic data is merely the start of a rebound from depressed levels. What we'll see towards the end of this year and into next year is firmer signs of longer-term economic recovery leading into 2022. And the markets in Europe and the UK haven't discounted that yet. The valuations are still depressed versus the global average. Europe is at a 6% discount. The UK is on a 26% discount. And earnings growth for this year is going to be very strong. In Europe, just over 30%. In the UK, just under 40% EPS growth. And our early guidance for next year's earnings per share growth is another positive year. So that lies ahead. We think there's a long tactical runway ahead of us of 12 to 18 months.